Hey everyone, welcome back to the channel. We're talking about investing today, and let me tell you, with how 24 has been going, you need to make sure you're investing safely in 2024, whether you're just starting out or you've been in the game for a while. This video is going to give you 10 actionable tips that you can use to protect your hard-earned money and make it grow. Because let's be real, nobody wants to lose money, right? We're talking diversification, index funds, real estate, and a whole lot more. I'll break down each strategy so you can understand exactly how it works and why it matters. Remember, knowledge is power, especially when it comes to your finances. So if you're ready to make 2024 your best investing year yet, smash that like button, hit subscribe so you don't miss out on future videos, and let's dive right in. Tip number 1 for investing safely in 24 is one of the most fundamental principles. Diversify your portfolio. You know what they say, don't put all your eggs in one basket. Well, the same goes for your money. Diversification basically means spreading your investments across different asset classes. Think of it like this. You wouldn't want to put all your money into just one stock, right? What if that company goes belly up? That's where diversification comes in. By investing in a mix of stocks, bonds, real estate, maybe even some commodities, you're essentially creating a safety net for your portfolio. If one asset class takes a hit, the others can help cushion the blow. The goal here is to create a balanced portfolio that aligns with your risk tolerance and your long-term financial goals. And trust me, this is a strategy that can benefit both seasoned investors and those who are just starting out. Now you might be thinking, Jay, how do I know what the right mix is for me? And that's a great question. There's no one-size-fits-all answer, but a good rule of thumb is to start with a mix of stocks and bonds. Stocks tend to be more volatile, but they also offer the potential for higher returns over the long term. Bonds, on the other hand, are generally considered less risky and can provide a steady stream of income. The specific ratio of stocks to bonds will depend on your age, your risk tolerance, and your investment timeline. Younger investors with a longer time horizon might be more comfortable with a higher percentage of stocks, while older investors might prefer a more conservative approach. The key takeaway here is to find a balance that you're comfortable with and that aligns with your overall financial goals. And remember, diversification is an ongoing process. You'll want to rebalance your portfolio periodically to make sure you're still on track. All right, moving on to tip number 2 for safe investing in 2024 index funds and ETFs. These are like the superheroes of the investing world, especially if you're just starting out. They're simple, effective, and can save you a ton of money in fees. Now, I know what you're thinking. Jay, what the heck are index funds and ETFs? An index fund is a type of mutual fund that tracks a specific market index, like the S&P 500. Instead of picking individual stocks, you're investing in a basket of stocks representing a sector or the entire market. ETFs, or exchange-traded funds, are similar to index funds, but are traded on stock exchanges. This means you can buy and sell them throughout the trading day. Both offer instant diversification because they hold a basket of stocks or bonds. But here's the best part. They're incredibly cost-effective. Actively managed funds often come with high fees that can eat into your returns. Index funds and ETFs are passively managed, resulting in much lower fees. This can make a huge difference in your investment returns over the long run. Every dollar you save in fees is a dollar that stays invested and working for you. Index funds and ETFs have a proven track record of outperforming actively managed funds over the long term. So if you're looking for a safe, effective, and low-cost way to invest in 2024, index funds and ETFs should be at the top of your list. Tip number 3, focus on blue-chip stocks. You know, when I first started investing, I was drawn to those flashy penny stocks, thinking I could get rich quick. Let me tell you, that's a quick way to lose your shirt. Instead, think of investing like choosing a reliable car. You want something that's been around the block, has a proven track record, and won't break down on you. That's where blue-chip stocks come in. These are the big daddies of the stock market. Companies like Apple, Johnson & Johnson, Coca-Cola. These companies have been around for decades, weathering recessions, market crashes, you name it. They're like that Toyota Camry that just keeps going and going. Blue chip stocks are known for their stability. They have a long history of consistent earnings and often pay dividends, which is basically a cut of the company's profits paid back to you, the shareholder. Think of it as getting paid to own a piece of these awesome businesses. Now, don't expect to get rich overnight with blue chip stocks. Remember, slow and steady wins the race. But if you're looking for a reliable investment that can form the bedrock of your portfolio, blue chip stocks are the way to go. So how do you actually pick out these blue chip companies? Well, it's all about looking at their fundamentals. Think of it like checking under the hood of that Camry before you buy it. You want to make sure the engine's in good shape, right? Start by looking at the company's financials. Check their revenue, earnings per share, and debt levels. Are they consistently profitable? Are they growing their earnings year over year? You can easily find this information on websites like Yahoo Finance or Google Finance. It's free and it's out there. Next, look at the company's competitive advantage. What makes them stand out from their competitors? Do they have a strong brand, a loyal customer base, a unique product or service? The stronger their moat, the better they can weather any storms. Finally, consider the company's management team. Are they experienced? Are they shareholder-friendly? A good management team can make all the difference in the long run. All right, moving on to tip number 4, consider bonds. Now, I know what you're thinking. Bonds? That sounds boring, but trust me, bonds are like the responsible older sibling of stocks. They might not be as exciting, but they bring stability to the party. Think of bonds as loans you give to governments or corporations. They borrow money from you and promise to pay you back with interest. It's that simple. Bonds typically offer fixed interest payments, which is great for generating consistent income. Now, there are different types of bonds. You've got government bonds, considered the safest because they're backed by the government. Then there are corporate bonds, issued by companies. These can offer higher returns, but also carry more risk. The key with bonds is to find the right balance between risk and return that aligns with your investment goals and risk tolerance. Remember, diversification is key. Don't put all your eggs in one basket, or in this case, one type of bond. So, how do you actually fit bonds into your investment portfolio? Well, it all depends on your individual circumstances and risk tolerance. A younger investor with a longer time horizon might opt for a more aggressive portfolio with a higher allocation to stocks. They can ride out the market's ups and downs. However, someone nearing retirement might prefer a more conservative approach, allocating a larger portion to bonds. This provides a steady stream of income and reduces the volatility of their portfolio. Remember, it's all about finding the right balance for your needs. Bonds are especially useful during times of market volatility. When the stock market takes a nosedive, bonds can act as a buffer, helping to cushion your portfolio from losses. Think of them as your safety net, catching you if you fall. Remember, investing isn't about getting lucky, it's about making smart, informed decisions. Bonds are an essential part of a well-diversified portfolio, providing stability, income, and peace of mind. Tip number 5, invest in real estate investment trusts, or REITs for short. Now, I love real estate. It's a tangible asset. It appreciates in value over time, and it can generate passive income. But let's be real. Not everyone has the time, money, or desire to become a landlord. That's where REITs come in. These are companies that own, operate, or finance income-generating real estate. Think of them like landlords in the stock market. They allow you to invest in a diversified portfolio of properties without the hassle of dealing with tenants, toilets, or termites. REITs typically focus on specific types of properties like shopping malls, apartment buildings, office spaces, or even cell towers. This specialization can be great for targeting specific sectors of the real estate market. It's all about diversifying your real estate holdings. One of the best things about REITs is that they're legally required to pay out a significant portion of their taxable income to shareholders as dividends. This makes REITs a great option for investors seeking passive income. It's like getting a monthly or quarterly paycheck just for being a shareholder. Now let's talk about the benefits of adding REITs to your investment portfolio. Firstly, REITs offer excellent diversification. By investing in a REIT, you're essentially spreading your money across multiple properties, reducing your overall risk. Secondly, REITs are highly liquid. Unlike traditional real estate, which can take months or even years to sell, REIT shares can be easily bought and sold on stock exchanges. This provides investors with greater flexibility and control over their investments. However, it's important to remember that REITs are still subject to market fluctuations. Just like any other investment, their value can go up and down depending on factors like interest rates, economic conditions, and the performance of the underlying real estate market. Before investing in REITs, it's crucial to do your research. Look at the REIT's portfolio holdings, management team, track record, and dividend history. Remember, knowledge is power. The more you know about REITs, the better equipped you'll be to make informed investment decisions. All right, before we dive into the next few tips, we need to talk about something crucial: your emergency fund. Investing is exciting, but you can't build a solid financial future on a shaky foundation. That's where your emergency fund comes in. Think of it as your financial safety net. It's there to catch you if you experience unexpected job loss, medical bills, car repairs, or any of those curveballs life throws your way. Without it, you might be forced to sell your investments at a loss to cover those costs. Ideally, your emergency fund should cover 3 to 6 months of living expenses. This may seem like a lot, but trust me, it's worth it. Having that cushion will give you peace of mind and prevent rash financial decisions. Remember, we're aiming for long-term financial success here, and that starts with a solid foundation. It takes time and discipline to build a healthy emergency fund. Start small, even if it's just $50 or $100 a month, and gradually increase it as you can. Look for areas where you can cut back on expenses and redirect that money towards your emergency fund. Remember, this is about playing the long game. Your emergency fund is the foundation of your financial future. Once you've established a comfortable emergency fund, you can breathe a sigh of relief knowing you're prepared for whatever life throws your way. All right, let's talk about staying ahead of the curve in the investing world. The market is like a living, breathing organism, constantly evolving and changing. What worked yesterday might not work tomorrow, so it's crucial to stay informed and adapt your strategy accordingly. Think of it like this. You wouldn't drive a car without checking the mirrors, right? You need to be aware of your surroundings, anticipate potential obstacles, and make informed decisions based on the information available to you. The same principle applies to investing. Now, I'm not saying you need to become a financial guru overnight, constantly glued to the Bloomberg terminal, but dedicating some time each week to research and stay updated on market trends, economic indicators, and industry news can make a world of difference. There are tons of resources available to help you stay informed. Subscribe to reputable financial news outlets, follow credible financial analysts, listen to podcasts, read books, whatever works best for you. The key is to find reliable sources and filter out the noise. Remember, knowledge is power, especially in the world of investing. The more you understand the market, the better equipped you'll be to make informed decisions and navigate its complexities. Don't be afraid to dig deep, ask questions, and challenge conventional wisdom. The more you learn, the more confident you'll become in your investment decisions. And that confidence will translate into better outcomes over the long term. Think of it like this. The more you know about a particular company, industry, or asset class, the better you'll be able to assess its potential risks and rewards. You'll be able to identify opportunities that others might miss and avoid pitfalls that could derail your progress. So, make it a habit to stay informed and continuously educate yourself about the world of investing. It's an ongoing process, but it's one that will pay dividends for years to come. Now let's talk about one of the biggest silent killers of investment returns: emotional investing. You see it all the time, people making impulsive decisions based on fear or greed, buying high and selling low. It's a recipe for disaster. Look, we're all human, and it's natural to feel a roller coaster of emotions when it comes to our money. But when you let those emotions dictate your investment decisions, you're essentially throwing logic and reason out the window. Think about it. When the market is soaring, it's easy to get caught up in the hype and FOMO, fear of missing out. You see everyone else making money and you want a piece of the action. But that's when you're most vulnerable to making impulsive decisions and buying assets that are overvalued. Conversely, when the market takes a nosedive, fear can set in. You see your portfolio shrinking and you panic, selling everything at a loss just to stop the bleeding. But that's often the worst possible time to sell, as you're locking in your losses and missing out on potential rebounds. That's why it's crucial to have a solid investment plan and stick to it, no matter what's happening in the market. Your plan should outline your investment goals, risk tolerance, and time horizon, providing a roadmap for your investment journey. When you feel those emotions creeping in, take a step back, take a deep breath, and remind yourself of your plan. Remember why you're investing in the first place, and trust in the process. Remember, investing is a marathon, not a sprint. Think of it like this: every successful investor has weathered market storms and come out stronger on the other side. They didn't achieve those returns by panicking and making emotional decisions. They stayed the course, stuck to their plan, and rode out the volatility. So the next time you're tempted to make an impulsive investment decision, remember this: emotions are not your friend when it comes to investing. Stick to your plan, stay disciplined, and let logic and reason guide your decisions. Tip number 9 is all about taking the emotion out of investing. We've all been there, watching the market like a hawk, trying to time the perfect moment to buy low and sell high. But let me tell you, trying to time the market is like trying to predict the weather 3 months in advance. It's nearly impossible. Instead of stressing about market timing, consider dollar cost averaging. This strategy is all about consistency and discipline. It involves investing a fixed amount of money at regular intervals, regardless of whether the market is up, down, or sideways. Think of it like putting your investments on autopilot. Let's say you decide to invest $500 every 2 weeks into an S&P 500 index fund. Some weeks the market might be down and you'll end up buying more shares at a lower price. Other weeks the market might be up and you'll buy fewer shares at a higher price. The beauty of dollar cost averaging is that it takes the guesswork out of investing. You're not trying to predict the market. You're simply investing consistently over time, which can lead to a lower average cost per share in the long run. One of the biggest advantages of dollar cost averaging is that it can help reduce the impact of market volatility on your portfolio. When you invest a lump sum all at once, you're exposed to the risk of buying at a market peak. But with dollar cost averaging, your investment is spread out over time, reducing the impact of any single market fluctuation. This can be especially beneficial in volatile markets like we've seen recently. Another great thing about dollar cost averaging is that it takes advantage of compound growth. As you invest consistently over time, your money has more opportunities to grow. And the earlier you start, the more time your investments have to compound. Remember, investing is a marathon, not a sprint. Dollar cost averaging allows you to participate in the market steadily, potentially reducing risk and taking advantage of compound growth. It's a strategy that can benefit both beginner and experienced investors. Now for our final tip, and this one's crucial. Even with all the information available online, sometimes you need a personalized touch. That's where seeking professional advice comes in. Look, I get it. We live in a DIY world. We've got apps for everything, and there's a YouTube tutorial for just about anything. But when it comes to your financial future, it's okay to admit that you might not have all the answers. A financial advisor can provide tailored guidance based on your specific financial situation, risk tolerance, and investment goals. They can help you create a comprehensive financial plan, choose the right investments, and navigate complex financial decisions. Think of a financial advisor as a personal trainer for your money. They can help you stay on track, make adjustments along the way, and ultimately reach your financial goals faster and more efficiently. Now, I know what you might be thinking. Financial advisors are expensive, and while it's true that they do charge fees, remember that they can potentially save you money and even make you money in the long run. The key is to find a fee-only fiduciary financial advisor who has your best interests at heart. Look for someone who's certified, experienced, and transparent about their fees. Many advisors offer free consultations, so don't hesitate to shop around and find the right fit for you. Remember, investing is a lifelong journey, not a one-time event. Having a trusted financial advisor by your side can provide invaluable peace of mind, knowing that you have a professional guiding you every step of the way. So there you have it, 10 safe investment strategies to help you navigate the markets in 2024 and beyond. We covered a lot of ground today, from diversifying your portfolio to the power of dollar cost averaging. Remember, investing is a marathon, not a sprint. By focusing on these safe and effective strategies, you can build a solid foundation for your financial future. If you found this video helpful, be sure to give it a thumbs up and subscribe to the channel for more investing tips and tricks, and let me know in the comments below, what are your investment goals for 2024? Until next time, happy investing.